something very unusual is happening around XRP right now, and most people are completely missing it because they are looking at price instead of liquidity, and that is exactly where smart money operates, not where the crowd is watching, because price is just the surface, but liquidity is the real game behind it. And when high price liquidity starts building, it usually means one thing: large players are preparing for a move that retail traders are not ready for. And if you understand this early, you don't just follow the move, you position before it happens. And that is exactly what we are going to break down step by step so you can see what's really going on before the market makes it obvious. Right now, most XRP holders are still focused on one simple question: when will the price go up? But that is the wrong question to ask if you actually want to understand what is happening in the market, because price does not move randomly. It moves toward liquidity. And liquidity is where orders are sitting, especially large orders placed by institutions. And this is where the idea of high priced liquidity becomes extremely important, because when liquidity starts building at higher price levels, it is not happening by accident. It is happening because someone with size is preparing for execution. You need to understand something very clearly. Retail traders usually buy when price is already moving up and sell when price is falling. But institutions do the exact opposite. They prepare positions quietly, they create zones of interest, and they wait for liquidity to build, because without liquidity, they cannot enter or exit large positions without moving the market too much. And that is why high price liquidity zones act like magnets, pulling price toward them over time. Now, here is where most people get it wrong. They think XRP needs news, hype, or some sudden event to move. But in reality, liquidity often builds before the narrative shows up, not after. And if you look at past market behavior, not just in crypto, but in traditional markets as well, you will notice that price often moves toward areas where large amounts of orders are sitting, and those areas are usually above current price when accumulation is happening. So when we talk about XRP high price liquidity, we are not talking about random speculation. We are talking about a structure where liquidity pools are forming at levels that are significantly higher than where price is currently trading. And this creates a very important question: why would liquidity be building higher if there is no intention to move price there? Because markets do not waste energy without purpose, especially not at scale. Another mistake people make is assuming that just because XRP has been moving slowly or sideways, nothing is happening. But sideways movement is often where the most important setups are built, because that is where accumulation takes place. And accumulation is not exciting, it is slow, it is frustrating, and it is designed to make weak hands exit before the move actually begins. If you think about it logically, large players do not want to chase price upward. They want to build positions at lower levels and then move price into liquidity zones where they can distribute or take profit. And this is why understanding liquidity gives you an edge, because instead of reacting to price, you start anticipating where price is likely to go. Now, does this mean XRP is guaranteed to move up just because high price liquidity exists? No. And this is where you need to stay grounded, because liquidity is a target, not a guarantee. And markets can always delay moves longer than people expect. But ignoring liquidity completely is even worse, because then you are trading blind. What makes the current situation interesting is not just that liquidity exists, but where it is forming. Because when you start seeing consistent liquidity building at higher levels, it suggests that the market is preparing for a potential expansion phase, and expansion phases are where the biggest moves happen, not during consolidation. But before you jump to conclusions and start expecting immediate price explosions, you need to understand the full structure behind this setup, because liquidity alone is not enough. You also need timing, catalysts, and market conditions to align. And that is exactly what we are going to break down next. Because what comes after liquidity buildup is where things start getting serious. and most people are not prepared for it. Building on the idea of high price liquidity, the next thing you need to understand is how liquidity zones actually get created in the first place, because they are not randomly appearing on charts. They are the result of consistent market behavior where orders cluster at predictable psychological and technical levels. And in XRP's case, these clusters often form above key resistance areas where traders expect rejection, but institutions see opportunity. When price stays below a level for a long time, traders start placing stop losses just above that level. And at the same time, breakout traders place buy orders slightly above it. And this combination creates a liquidity pocket because both sides of the market are now sitting in the same region, waiting to be triggered. And this is exactly what smart money looks for, because they need volume to enter or exit large positions efficiently. Now, here is the part most retail traders misunderstand. They think breakouts happen because buyers suddenly become aggressive. But in reality, many breakouts are engineered through liquidity sweeps, where price moves into a zone that triggers stops, absorbs liquidity, and then either continues or reverses depending on the broader structure. And XRP has historically shown behavior where these sweeps occur before larger directional moves. If we apply this thinking to XRP high price liquidity, it suggests that the market is not just sitting idle, it is actively building a map of where future trading activity will occur. And these higher zones become important because they represent areas where large orders are likely waiting, not because of emotions, but because of strategy and execution needs. Another critical point you need to consider is time. Liquidity does not get consumed instantly, it accumulates over time. The longer a price remains below a high liquidity zone, the more orders tend to stack up above it, because traders become more confident that a breakout will eventually happen, and this confidence itself adds more fuel to the liquidity pool. But here is where discipline matters. Just because liquidity is building does not mean price must go there immediately. And markets often create what looks like a clear path, then delay the move to shake out impatient traders. This is where most people lose, not because their idea is wrong, but because their timing is emotional instead of structural. In XRP's situation, if high price liquidity continues to build while price remains compressed, it creates a pressure effect. Think of it like energy being stored. The longer the compression lasts, the more violent the potential expansion can be. But again, this only matters if there is a trigger that forces price into that liquidity zone. That trigger could come from broader crypto market movement, Bitcoin volatility, regulatory updates, or even large order execution from institutional desks. But the key point is that liquidity alone is not the catalyst, it is the target. Without a catalyst, liquidity remains unused. But once momentum enters the system, price tends to move rapidly toward the areas where liquidity is concentrated. This is also where patience becomes a real advantage. Most traders lose because they try to predict exact timing instead of understanding structure. They see liquidity building and immediately expect a breakout. But smart analysis requires recognizing that liquidity is only one layer of the equation, not the full picture. So as we move forward, the real question is not just where liquidity is forming, but how price behavior is reacting around these zones. Because reaction tells you intention, and intention is what separates random movement from structured market design. And in the next part, we are going to break down how XRP's price behavior around these liquidity zones can reveal whether accumulation is still active or whether distribution is already starting to take control. Now that you understand how liquidity zones are formed and why high price liquidity matters, the next step is to focus on price behavior around these zones, because liquidity alone is meaningless if you cannot read how price is interacting with it. And this is where most traders completely lose the plot. They see levels on a chart, but they don't understand the behavior behind those levels. When XRP or any asset approaches a high liquidity area, the way price moves into it tells you a lot more than the level itself. If price is moving slowly, compressing, and repeatedly testing resistance without strong rejection, that usually signals absorption, meaning large participants are quietly taking positions while price remains stable, and this is often a sign of accumulation, not weakness. On the other hand, if price spikes aggressively into liquidity zones and immediately rejects with high volatility, that often indicates a liquidity grab rather than a true breakout attempt, meaning the market is just sweeping orders before moving back into range. And this is where traders who chase breakouts often get trapped because they mistake manipulation for direction. In XRP's current context, the focus should not only be on whether high price liquidity exists, but how price is behaving while moving toward those zones. If price is respecting higher lows while gradually pushing upward into liquidity pockets, that suggests controlled pressure building, not random movement. And controlled pressure is usually what precedes expansion phases. Another important detail is volume structure. Many people ignore volume because it looks simple, but in reality, volume tells you where participation is increasing. If XRP shows increasing volume while approaching high liquidity levels, it can indicate that interest is building around those zones and that larger participants may be positioning ahead of a potential move. But here is the reality check you need to hear clearly. Not every liquidity buildup leads to an upward move. Sometimes liquidity is created for distribution, not accumulation, and this is where bias destroys traders. If you assume every structure is bullish, you will eventually get caught on the wrong side of a reversal. So the real skill is not identifying liquidity, but interpreting intent. And intent is read through structure, not emotion. For example, if price repeatedly fails to break a key level, but keeps returning to it with stronger pushes, that often shows underlying strength building. But if price breaks a level and immediately loses momentum, that is a warning sign that the move lacks conviction. In XRP's case, high price liquidity becomes even more important when you connect it with historical behavior. XRP has a tendency to move in phases of long compression, followed by sudden expansion, and these expansions are usually fast enough to catch most retail traders off guard because they happen after a period of boredom and frustration. That frustration phase is important because it is where weak hands exit and strong hands accumulate. The market does not reward impatience, it exploits it. So when you see XRP staying compressed while liquidity continues building above, the real question is not when breakout, but who is still holding and who is being forced out. This is also where false confidence becomes dangerous. Many traders assume that once liquidity is visible, the direction is obvious, but markets are designed to create uncertainty. They will often build liquidity on both sides over time, not just one side, and the final move usually targets the side with the most concentrated stops. So instead of predicting direction too early, you should focus on structure confirmation. Is XRP still respecting support levels consistently? Is volatility decreasing while liquidity increases above price? Is there a gradual tightening range forming? These are the real signals that matter. At this stage, XRP is not just about price movement, it is about pressure building within a structured range. And that pressure will eventually resolve in one direction. But until that resolution happens, the market will continue to test patience, confuse bias, and reset expectations repeatedly. We are going to break down what happens when liquidity actually gets taken, how fast price can react when these zones are triggered, and why most traders miss the actual move, even when they correctly identify the setup beforehand. Now, we move into the most important phase of this entire structure, what actually happens when high price liquidity gets triggered, because this is the moment most traders are mentally prepared for, but practically unprepared to handle. And this gap between expectation and execution is where most losses occur. When price finally reaches a high liquidity zone, The reaction is usually not gradual, it is often sharp and fast because liquidity zones are not just targets, they are execution points, meaning large orders get filled in a very short window. And that creates sudden volatility that catches retail traders off guard. In XRP's case, if high price liquidity above current price levels starts getting tested, the first thing you will often see is a quick expansion in volatility, not necessarily a clean breakout, but a fast move that pushes into the zone, triggers stop orders, and absorbs buy or sell pressure depending on the structure at that time. This process is often misunderstood. Many traders see the move into liquidity and assume it is a breakout, but in reality, it can be a liquidity sweep where the market intentionally moves into an area to collect orders before reversing or continuing with stronger momentum. The key difference lies in what happens immediately after the liquidity is taken. If after hitting the liquidity zone, price holds above structure and continues building higher lows, that usually confirms continuation, meaning the liquidity was consumed and the market is ready for expansion. But if price immediately rejects and falls back into the previous range, that often signals a failed breakout and possible trap formation. Now, here is the part that separates experienced traders from everyone else: speed. When liquidity gets taken, the reaction is often fast enough that hesitation leads to missed opportunities. Traders who wait for confirmation sometimes enter too late after the move has already expanded significantly, while traders who enter too early often get caught in false moves. This is why understanding pre liquidity behavior is just as important as post liquidity reaction. If XRP shows strong compression, decreasing volatility, and consistent higher lows before reaching liquidity, the probability of a strong expansion increases. But if price is erratic and unstable before reaching the zone, the reaction becomes less predictable. Another important factor is market context. XRP does not move in isolation. Its liquidity reactions are influenced by broader crypto market conditions, especially Bitcoin dominance and overall market sentiment. If the broader market is in expansion mode, liquidity grabs tend to lead to continuation. If the market is uncertain or bearish, liquidity grabs often lead to rejection and range continuation. So when we talk about high price liquidity being taken, we are not talking about a guaranteed breakout. We are talking about a high volatility event where direction is decided in a very short time frame based on existing structure and momentum. One thing you will also notice is that liquidity zones are rarely clean single levels. They are often clusters of price areas where multiple orders exist, meaning price may react multiple times within the same zone before a final direction is established. This creates confusion for traders who expect instant clarity, and this is where emotional trading becomes dangerous. When price enters a liquidity zone, traders often feel pressure to act quickly, either entering breakouts or shorting reversals without waiting for structure confirmation. And this emotional reaction is exactly what smart money relies on because liquidity zones are designed to create uncertainty. In XRP's scenario, if high price liquidity continues building above current price, the key focus should not be predicting the exact spike, but understanding what type of reaction is most likely based on current structure. Is the market compressing tightly into resistance, or is it showing signs of exhaustion before reaching the zone? Because the reality is, once liquidity gets triggered, the market will not give you much time to think. It will move first, and explanation will come later, not the other way around. And in the final part, we are going to connect everything together, what this liquidity structure could mean for XRP's broader trend direction, what traders should realistically expect instead of fantasies, and how to avoid getting trapped in both bullish and bearish biases while navigating this type of market condition. Now, everything comes together because understanding high price liquidity is not about predicting a single move. It is about understanding the larger structure XRP is building over time. And once you step back and look at the full picture, you realize the market is not random at all. It is structured around zones where liquidity accumulates, gets tested, and eventually gets consumed in phases. At this stage, XRP's behavior should not be interpreted as isolated price action, but as part of a broader cycle where compression, accumulation, and liquidity building all interact. When high price liquidity remains above current price for an extended period, it creates a natural point of interest for the market. But the timing of when that liquidity gets activated depends entirely on momentum and external conditions. One of the biggest mistakes traders make is assuming that liquidity automatically means upward movement. That assumption is incomplete. Liquidity simply means potential, not direction. It tells you where the market can move efficiently, not where it must move. XRP can just as easily use liquidity zones above price for distribution as it can for continuation, depending on the underlying structure. So the real question becomes this: is XRP currently in an accumulation phase preparing for expansion, or is it in a distribution phase preparing for a reversal or slowdown? And the answer is never found in one indicator or one candle. It is found in behavior over time. If you observe consistent higher lows, controlled pullbacks, and repeated resistance testing without strong rejection, that usually leans toward accumulation, especially if volatility is gradually decreasing. In that scenario, high priced liquidity becomes a natural target for expansion because the market is building energy to move into those zones. However, if you see weakening momentum, repeated failures to hold support, and increasingly aggressive rejections from resistance, then high price liquidity becomes less of a bullish signal and more of a potential trap zone where price might briefly spike before reversing or losing momentum. This is why context is everything. XRP is not traded in isolation, it is influenced by macro liquidity, Bitcoin cycles, and overall market risk sentiment. Even the strongest liquidity setup can fail if the broader market is not supportive. That is a hard truth many traders ignore because they focus too much on the chart in front of them and not enough on the environment around it. Now, let's be very practical. If high price liquidity continues building above XRP's current range and price remains compressed with tightening structure, the probability increases that the market is preparing for a volatility expansion phase. But that expansion can go in either direction first because liquidity exists on both sides of the market, not just above price. This is why patience and structure reading matter more than prediction. Instead of asking, will XRP go up? The better question is, what conditions would force XRP to move aggressively in either direction? Because that shifts your focus from guessing to understanding. And here is the final reality check most traders don't want to hear. Even when liquidity analysis is correct, timing is still the hardest part. You can identify the exact zone, the exact structure, and still get caught early or late if you act emotionally instead of structurally. That is why professionals don't chase moves. They wait for confirmation of reaction after liquidity is engaged. So, what should you actually take away from this entire breakdown? First, high price liquidity is not noise, it is intention mapping. Second, XRP is likely in a phase where the market is preparing for a larger directional move, but that direction is not confirmed until liquidity is actually tested and price reacts. And third, your edge does not come from predicting the move, it comes from understanding the structure before the move happens. If you can learn to detach from emotional bias and focus only on structure, liquidity, and reaction, you stop being part of the group that gets trapped and you start operating like someone who understands how the market actually functions beneath the surface. financial disclaimer. This content is for educational and informational purposes only and should not be considered financial advice. Cryptocurrency markets are highly volatile and risky, and you should always do your own research before making any investment decisions. Nothing in this script guarantees any price movement or outcome. If you find this analysis helpful, consider supporting the channel by liking, sharing, and subscribing for more XRP market breakdowns and updates.